Welcome back. This is episode 234. This week, I'm honored to be joined by investing legend, Larry Swedroe. Larry is the author and co-author of 18 books on investing. He's also the former principal and director of research for Buckingham Strategic Wealth, where he recently retired after, 28 years. And his latest book is Enrich Your Future, Keys to Successful Investing, that we plan to dive into today. So welcome, Larry.
Thanks for having me, Ryan. Glad to be with you.
Yeah, so 18 books. That's incredible. I just earlier this year published my first book, and I can't imagine doing another, let alone 17 more.
Yeah, actually there's 21 because there are 3 sequels. Updates.
Oh, wow. Okay. So, yeah. So before we get into the recent book, just what's your process for writing a book?
Yeah, when I joined Buckingham back in 1996, our investment strategy was based upon peer-reviewed academic research, which showed that while it certainly is possible to outperform the market through what's generally called active management, which I define as either individual stock selection and/or market timing. So it's possible to beat the market, but the odds of doing so were so poor, it isn't prudent to try. And at the same time, my first book came out in 98. Charles Ellis's book, Winning the Loser's Game, he basically said that, active management is a loser's game. It's just like going to the casinos in Las Vegas, where you do have a chance to win, but the odds of doing are so poor, the winning strategy is not to play. So when I joined Buckingham in 96, I went to see if there was any book we could give somebody to read to learn about this strategy and the evidence. And the only book in 96 that was out there was A Random Walk by Wall Street by Burt Malkiel, which is a great book and well known. And the problem was 2 things. One, it was about that thick. Many readers wouldn't read it. And number 2, while it told you that the right strategy was to be, the general word is passive investor, meaning not engaging in stock picking or market timing, he didn't tell you what to do with that information.
Sure.
Didn't tell you how to construct a portfolio, for example, based upon one's own individual ability and willingness to take risks. It didn't get into, at the time, Nobel Prize winning work by Gene Fama and his partner Ken French, showing that there were other factors, that's the technical term in finance, but it just means traits or characteristics of stocks that Fama and French had identified in the literature that showed that these factors contained risk premiums, and you could outperform the market likely over the long term by tilting your portfolio to those factors. So I set out to write a book that would help people understand that, and that became the only guide you'll ever need to win an investment strategy. And over the years, as the director of research for Buckingham, I was writing articles typically once a week, talking about what the academic research had found, both in terms of finance and, importantly, also the field of behavioral finance. So a couple of years later, I had enough material to write a second book, and that became What Wall Street Doesn't Want You to Know. And then we had the internet bubble, lots of irrational investing, I thought. So I wrote a book called Rational Investing in Irrational Times. And eventually I wrote Your Only Guides to Successful Bond Investing, Alternative Investments, and then the other 13 other books.
You just kept going.
Just kept going. Basically using material that I was writing, to help investors and our own clients to understand what the winning strategy was.
Yeah, so it's not, you weren't starting from scratch every time. You kind of had a blueprint with what you were going with.
Exactly.
Yeah.
And the most important thing for me was I got lucky. I was hooked up with an English professor at Columbia University who was a literary agent. named Sam Fleischman. And he read my first book and said, Larry, I think you've got a good book here, but you have to make it much more accessible. So whenever I would describing some factor or strategy, he said, Larry, you need to tell a story or use an analogy that people are familiar with, and if they understand that analogy, say related to cooking or gardening or movies or sports or history,
Sure.
you could then translate it into finance. So a good example, I would sit down with my wife, who's a very bright woman, master's degree in career counseling, but knows nothing about finance, which is typical of most American, both men and women.
Sure.
Because unless you've taken an MBA in finance, likely you've never taken a single course on capital markets theory. So she's intelligent but ignorant. That's not a pejorative term. I'm ignorant about lots of things like nuclear physics. My wife and 3 daughters tell me women is another subject I'm ignorant about.
Most of us are, Larry. Don't feel bad.
Yeah, so she would say, Larry, you need an analogy, and I would work with her to create one. So a good example, if you know anything about baking, my wife is a master baker, and if you want to sweeten cookies or cake, people would think you would add sugar, but you actually can add salt to make it sweeter. And so that idea helped me explain diversifying a portfolio, that you can add a risky asset to a portfolio if its correlation was low enough or even better negative to other assets, it could reduce the risk of the overall portfolio. And so I learned to write stories, analogies to Greek mythology, for example, and sports betting, etc., to make these difficult concepts easy to understand. And my latest book, Enrich Your Future, is a collection of about 40 stories that help people understand the right way to invest and shows that much of what they believe they know about investing are myths that Wall Street needs and wants you to believe so you make them rich, not yourself.
Sure. Yeah, your first book, the only winning guide to investment strategy you'll ever need, definitely had an impact on me and how I manage client portfolios. I started with Morgan Stanley in 2001, and definitely, they weren't talking about building passive investing strategies. It was really active management. That's what they promoted, and it wasn't until later that I started to educate myself about what else was out there that I really understood, maybe that's not the best strategy. Do you think Wall Street is doing, over 20 years since you wrote that book, are they doing a better job of embracing passive investing?
Well, I think you have to broaden the term Wall Street to beyond what most people think. I think the financial community is doing a much better job, led originally, of course, by Vanguard, with the whole concept of indexing, led by a legend, John Bogle. And then dimensional fund advisors came along, and they focused mainly originally on institutional investors, showing how you could use the empirical evidence from peer-reviewed research to improve outcomes, build more efficient portfolios. And now firms like BlackRock and Avantis and Bridgeway and AQR are all making these strategies backed by peer-reviewed evidence available to investors and at much lower cost. So today we've gone from about 1% or so passive strategies or index-like strategies when I first started to the estimates are as high as about 50%. So obviously, the financial community is doing a much better job there. Fees have also come way down, and
Sure.
so that's helping investors capture more returns as well. But still, most of what we would think of Wall Street, the Morgan Stanleys and J.P. Morgans and Templetons and everybody else, they're still promoting active management, which is for them the winning strategy because they charge higher fees for it.
Sure.
It doesn't mean it's the winning strategy for you.
Yeah, I definitely see that. I mean, when I have prospective clients come in and review portfolios, I'm still seeing a lot of high cost mutual funds, a lot of active funds and in managed accounts. It just seems like they can't get past that.
Yeah, and the interesting thing that most people don't even know, it's not active management doesn't lose because it's dumb. Active management loses because it's more expensive.
Sure.
In fact, the academic research shows that on average, the stocks that active managers pick actually go on to outperform the market by about, call it 70 basis points. At least that was the study done by Russ Wormers about 20 years ago. Might be, I would guess, a bit lower today, but it's still positive. But the problem is they have expenses which include not only their expense ratio, but trading costs, bid-offer spreads, and really importantly, that many investors don't understand, is market impact costs, which have gone way up for active managers for some technical reasons I'm happy to discuss. But you have to remember that beating the market on a gross basis is a zero-sum game. If somebody wins because they overweighted NVIDIA, somebody must also then underperform because they underweighted NVIDIA.
Sure.
But once you add in costs, including trading costs, expenses of the fund, and even the cost of cash, on average the market goes up, and active funds typically are holding 5 to 10% cash. And if cash is earning today 4.5%, and the market's going up this year 28%, that's a drag. So that is also there. So their net returns are negative. Okay, that's what causes them. So if you could find, and there are very few of them, but find active managers that have low costs, meaning low expense ratios, and have low turnover, so they have low trading costs, and stick to their asset allocation so you keep control over the risk of your portfolio, you're likely to come close and maybe even beat the market if their costs are low enough. And there's only really one fund family that really meets that definition, and that would be Vanguard's active fund.
Sure.
And over the years, I did comparisons of about 30 fund families, benchmarking their funds against a proper index and against DFAs and Vanguard funds. And the only fund that managed to outperform the index, and it was by a small number, was Vanguard funds. And it was not a statistically significant difference.
Yeah.
But they did outperform. So, the problem today for active managers, and Andy Birkin and I wrote our book, The Incredible Shrinking Alpha, meaning it's getting harder and harder to outperform.
Yeah, alpha being outperforming the market, right?
On a risk-adjusted basis,
Yep.
right? So when Charles Ellis wrote his book in '98, the same year my first book came out, about 20% of active managers, he pointed out, were generating statistically significant alpha. But that's pre-tax.
Sure.
For most investors, most of their assets are going to be, especially higher net worth investors, going to be in taxable accounts, and that's the highest expense, greater than their trading costs, greater than typical expense ratios, is in taxes. So maybe it was 10% were outperforming. That's still lousy odds.
Yeah.
80 or 90% odds of losing. It was only 12 years later, for the reasons Andy Birkin and I point out in our book, Fama and French did a similar study and found that the 20% that were beating the market on a statistically significant basis had dropped to 2%. So call it 1% after taxes. So the market has gotten much tougher to beat, partly because the competition's gotten tougher, and that's because the naive retail investors are basically disappearing from the market. In 1945, 90% of all stocks were held in individual brokerage account, which means when Warren Buffett traded, the odds were 90% he was trading against you or me.
Sure.
And he's smarter than us, had more and better information, so he would likely be able to generate alpha, and did. for the first 40, 50 years of his career. Today, since so little is held directly by individuals, maybe 10% of all trading is done by individuals now. That means there's a 90% chance when Buffett is trading, he's trading against Renaissance Technologies or JP Morgan or some other sophisticated institutional investor. Now that competition is much harder to exploit. The data shows that the stocks that individual investors buy on average go on to underperform after they buy them, and the stocks they sell go on to outperform after they sell them. So the winners, there's got to be a winner there.
Yeah.
It is the institutions, but there's not enough of them anymore. And the competition has just gotten much tougher. Almost all the money that's actively traded today by institutions is run by world-class mathematicians, physicists with the best databases in the world, the fastest computers, and that makes the competition much tougher than it was 20, 30, 40 years ago.
Yeah. Now, you mentioned Warren Buffett. I mean, I know historically he was lauded for his outperformance of the markets. Has he been keeping that track record up in recent years?
I actually wrote a book in 2008 called Think, Act, and Invest Like Buffett, showing investors that they could invest like Warren Buffett without engaging in any stock picking and market timing by buying an index, if you will, of the types of stocks that Buffett bought. He had made no secret of his secret sauce. For decades, he would write in his annual Berkshire shareholder letter, buy stocks that are cheap, profitable, have strong balance sheets, are stable earnings, less volatile. And today we would call them quality stocks, and lots of systematic strategies that don't engage in any individual stock selection, like funds run by Dimensional, AQR, and Avantis, all buy those same types of stocks. So
Sure.
The competition has got much tougher. In fact, I wrote some pieces showing that since '08, Buffett has not outperformed the market, and that's because the reasons I mentioned in my book, The Incredible Shrinking Alpha, it's got much tougher, and everyone can replicate Buffett. So it's harder for him to uncover mispriced stocks than it was certainly 40, 50 years ago.
Sure. Yeah. So in your new book, Enrich Your Future, you talk about, you mentioned stories, right? I think you had one story about, you were learning to play tennis and how you were, had considered yourself a good athlete, but you found that didn't really translate, into being a good tennis player.
Yeah. So I played some Division III, college basketball. I was a good athlete and, growing up playing all the sports. But in the Bronx, there were almost no tennis courts. The only tennis I played was over a few summers it was called wall tennis. And there was a box on a wall that
Almost
you would
like
hit a ball
handball
against.
or paddleball. Yeah.
Similar, but with a tennis racket.
Sure.
Then I moved to California where everybody played tennis because you had beautiful weather all year round. And I got out on the court without taking lessons. And, I would do okay. But I'd play against guys who were much older than me, nowhere near as good an athlete, and they would beat me. So I finally decided to be intelligent, go take some lessons. And when I was hitting with a tennis pro, he hit a shot to my backhand deep in the corner. Of course, that would have been my weaker stroke. And I wound up, hit a winning passing shot right down the line and beat the pro. And he called me up to the net and said, "Larry, that shot's your worst enemy." And I said to him, "I just hit a great shot." And he said, "Yeah, he could make that shot 9 times out of 10. I would make it maybe once or twice out of 10, but I'd remember and it would feel so good, I'd want to keep repeating it." He said the strategy in tennis at your level, okay, meaning, most weekend players or unless
Sure.
you're a club pro, is to just get the ball back with some pace down the middle of the court. don't make errors. The winning strategy is not to lose. So he said, at your level, most points are lost, not won. Okay?
Yeah.
So the same thing, when I was writing my book, said the same thing applies in investing. Most people think the winning strategy is to try to hit that winning shot, meaning find the next NVIDIA.
Yeah.
Well, let me
Yeah.
give you some data and for your audience to show you how hard that is. Most investors, I believe, if not all, will be shocked at the data I'm now going to describe. If you, over the long term, stocks have gotten about 10%, and let's say treasury bills have gotten 3, just round number. So stocks have earned an annualized risk premium of about 7%. 4% of all the stocks that have ever been listed account for 100% of that entire risk premium.
Wow.
Out of the tens of thousands of stocks. So you have to ask yourself, what are the odds that you, doing work part-time, not full-time, don't have access to databases, can't interview the company presidents, you're not listening on the earnings calls, and you don't have a PhD in science and math, and you don't have access to all the databases, etc. What are the odds that you are going to identify those stocks in sufficient quantity to outperform the market? That's why most active managers fail. Most people think that if the market gets 10%, the average stock gets 10%. It's way wrong. The median return is well below the mean, because while the most you could lose is 100%, the most you can make, like with NVIDIA, is in the thousands of percent. So the key is the median stock earns well below 10, and the more stocks you earn, you have a greater chance of earning the mean return, which has been 10. So the concentration is a risky strategy which doesn't make sense unless you have inside information, and Martha Stewart found out what happens when you trade on that and get caught.
Yeah. Yeah, it's definitely hard, right? I mean, I don't know what you would call it. I don't know if it's recency bias, but where you do have success with a stock, and you think, oh, I can replicate that. I got lucky and I bought Microsoft years ago, or Apple, and you want to keep all your money in those or try to find more and take a lot of risk in doing it.
Yeah. Well, we all have this tendency it's, I would say, an all too human characteristic or trait, and behavioral psychologists have written on this extensely. We tend to remember our winners and forget our losers. The data is so bad that in a study done on investors, a group was asked, what percent, did you beat the market? And something like 70% or 80% said they had beaten the market. The fact of the matter was the vast majority had no idea what their returns were, and something like a third of the people who said they had beaten the market actually lost money during the period that the market had provided strong returns. We blind ourselves to our bad outcomes because it would be too damaging to our egos to remember them.
Sure. Yeah, I've seen studies too. I don't remember exactly who did the study of average investor returns over like a 20-year period, and they sampled brokerage accounts, and let's just say the S&P made 8 over those 20 years, average annual return, the investors made like 3 because they're just really doing the wrong thing at the wrong time. Could be timing, but it also could be just trying to outperform the market and picking a handful of stocks.
Yeah, here's the thing that I try to teach investors is what the vast majority of them make the mistake of is failing to differentiate between knowledge and value-added knowledge, or information and value-added information. So somebody comes to me and says, Larry, I'm loaded up on this stock, I've got a big position. I say, okay, tell me why, give me the reasons why you think the stock is likely to outperform, because you're taking, you must admit, significantly more risk when you concentrate that. What if that company becomes the next Kodak or Polaroid or Enron or whatever, right? and they give me, say, 10 reasons: great management, a strong balance sheet, or here's these products. And the next question I say, okay, let's assume for the moment that's 100% accurate. Are you the only one who knows this? The smart people at Renaissance Technologies and Warren Buffett and J.P. Morgan and Morgan Stanley, the analysts there who are spending 100% of their time doing the research, none of them are aware of this. And let's say the stock you are interested in buying is trading at 30 and you're buying it because you think it's really worth 40. My question to you is, if it's really worth 40, why aren't the people at Renaissance Technology buying it and driving the price up if they thought it would be worth 40, as the other active managers who have more information than you? It would be 40 if they thought it was 40, not 30. So obviously the collective wisdom of these high-powered investors who are driving prices must believe it's only worth 30. Look yourself in the mirror and give me the reasons why you have an advantage over them in understanding what the future is likely to be. And then you get this blank stare because they can't come up with anything that says the other people don't have this information. Simply not true. And that's the problem for active investors. They think they're smarter than the market when they don't have either the training, the skill, the knowledge, the time, the discipline to do it. That's true of the vast majority of investors. Now, the last point I'll make is this. Many people will admit that it's dumb to try to beat the market, but I'm not the average investor. And overconfidence is another all-too-human trait. Doesn't matter what the question is. There was a study done in Sweden on drivers. And they asked people, are you a better than average driver? And 80% of the people said yes. Of course, that can't be true. The same thing is true if you ask them, are you liked by others better than the average person? 80 to 90% say yes. Are you a better lover than average? It doesn't matter, right? Here's the best story I know on overconfidence and why you shouldn't try to pick stocks once you understand what the competition is. The people took the study on driving to the next level, and they interviewed people and asked them this question. The last time you were driving, how would you rate your skills? Better or worse than average or average? And again, the vast majority said they were better. However, this was a unique group, handpicked. They were all people who were in an ambulance headed for the hospitals because they were in an accident, and the vast majority of them were identified as having caused the accident. Yet most of them said they were better than average drivers the last time they were driving.
It wasn't their fault, Larry.
Yep.
It was the other driver.
So that's a good thing. Don't be overconfident about your stock picking skills.
Yeah, so definitely, using a lot of index-based approach or, really, really low-cost active management would probably be prudent for most people, right, rather than trying to outperform, pick their own stocks.
I have not bought an individual stock in 30 years, and I went to school to be a security analyst and portfolio manager. But the evidence convinced me that even with my training, the odds of my being able to outperform were very low, especially when you included the costs of doing so. So indexing is a perfectly rational strategy. I don't own any index funds because there are some negatives of indexing that can be minimized, if not eliminated, by intelligent design. A good example is the Russell 2000 has underperformed other small cap indices like that of the Center of Research and Security Prices at the University of Chicago, or the S&P 600. It's just a poorly designed index that can be front-run by active managers, high-frequency traders. Even the S&P has underperformed the stocks in the index, and most people don't know this, by about 40 to 50 basis points, because the high-frequency traders exploit their knowledge of when the index is going to change, and they run up the stocks. But it doesn't show up in the index returns because they go by the last price, and that's when everyone does their trading.
Sure.
So, for example, if you know Apollo is going to go into the index, or have a high odds of believing that, people will start to buy Apollo before it gets announced, driving the price up, and so therefore they get those returns, and then afterwards it tends to revert back to where it was before then. So that's an example. So I don't own any funds that are indexed, but they are all systematic. They define their eligible universe. They're transparent, so I know exactly what the rules are. And they have one other advantage. They all patiently trade, so they don't get trapped and lose money and exploited by the active manager. In fact, dimensional fund advisors, which is a large, hundreds of billions of dollars of passive, if you will, strategies, although they don't use that term because they're active in designing their funds. But once they design them, there's no individual stock selection or market timing. Almost all their trades are 100 shares at a time because they don't want to pay market impact costs, which active managers pay when they demand liquidity from the market to either buy or sell. They'd rather earn a liquidity premium by providing liquidity to the market by slowly trading and accepting what the market price is. So all the funds that I own are all passive in the sense they just define the universe, buy and hold those stocks as long as they're with their index, and then patiently trade.
Sure. Regarding most of my podcast is a lot of pre-retirees and retirees, and obviously people start to think about, okay, now I'm retiring and I need income. A big thing I get asked a lot is, okay, should I be in dividend-paying stocks, right? Shouldn't I be in stocks that pay a high dividend now that I'm retiring and needing income?
So this is one of my favorite subjects, if you will, because there are a lot of people who believe religiously in dividends. When 60 years ago, University of Chicago professor wrote a paper showing that dividend policy is completely irrelevant and should not affect returns in any way. What that means is once you hold dividends constant, stocks that have the same dividend yield should have the same expected returns if dividend policy is irrelevant. And that's exactly what the data shows. So if you bought stocks that had, say, PEs, just to pick a number, below 15, and if you bought the stocks that had a 5% dividend versus a 1% dividend, they've had the same returns. And dividends in taxable accounts is a bad strategy because you're paying taxes on those dividends, where if instead the company retained the earnings, they could grow a bit faster, number one. But number two, if instead of returning capital by paying a dividend, they bought their stock back, that would be a return of capital, and the shareholder, that would push the share price up by the same amount as the dividend, if you will. Okay. And the shareholder, if they need cash flow, investors don't need income. That's what they don't understand. They may need cash flow. So if you need cash flow, let's say you own a stock and you've got 100 shares and it pays $1 dividend, and it earned $1, just to make the math simple. So the stock price should go up from 100 to 101 during the year, and now it pays you a dividend, right? And the stock price has to go back to 100 because $1 is worth $1, all right? And you've got that $1, but you have to pay taxes on it. And you pay tax on the full $1.
Sure.
I own the same stock. Instead, it buys back its shares, or doesn't. Let's assume it doesn't. It just keeps the cash. And I now need that $1 cash. So I sell one share. And Now I'm paying a tax only on the percentage of the gain, which was a much smaller amount than the full dividend, right? And pay it as a capital gains tax as well. And that may matter depending on whether the dividend is qualified or not. So you're better off just owning stocks that have characteristics that the evidence shows are likely to deliver higher returns. So Warren Buffett would tell you to buy stocks that are cheap, meaning low price to earnings, low price to cash flow, etc., and are profitable, higher quality stocks. And you can buy those from many funds like Dimensional, Avantis, AQR, and BlackRock, and even Vanguard, etc. That would be the better strategy. If you need cash flow, you can create your own dividends that way.
Yeah, just liquidate what you need, essentially, right?
Just liquidate, and when you need it. You're not forced to take cash flow. Many people may not need the dividend, and they're forced to take it and pay tax.
Yeah, as your portfolio builds up, if you've got a taxable account and now you're getting, let's say, $80,000 a year of dividends, like that's a lot of income that you're going to have to pay tax on. Whereas if that was only $20,000 because it was mostly being reinvested, that's a lot better.
Yeah. Here's the thing that most people don't understand. Dividends are not income except for tax purposes. They're just returning capital back to the investor. It's in effect forcing you to sell shares because the stock price drops to reflect the dividend. I mean, it's crazy how many people don't understand that simple concept. If a company is worth $100 and has $4 in cash, and you pay out that cash, the stock has to be worth 96.
Sure.
It still can't be worth the same 100 because it has $4 less of assets. Unless you think a dollar is not worth a dollar.
Yeah, I've had people, obviously tell me, "Oh, this is going to pay a big dividend. Let's buy the stock before," and they don't realize, like you just discussed, that the stock will drop, X dividend to reflect what the cash was that it just paid out. So you didn't even make any advantage off of that.
Yeah, exactly. Yeah. And you're going to pay tax on it.
That's right. So one of the things you talked about, too, in the book is just, how people should determine the amount of risk they take, right? I mean, I preach asset allocation and understanding, okay, what's the potential fluctuation in your portfolio, right? Because you can look at a given asset class and you could know what the worst case scenario might be looking at past markets. But there's some more stuff that you talked about in the book beyond that.
Yeah. The most common way people think about investing is they think about their age, years to retirement, and think of that as the investment horizon. So a rule of thumb that many people follow used to be 100 minus your age is your equity. So if you're age 60, you should have 40% equity. That rule has been changed to be more like 110 years because we're now living a lot longer. The problem with that is two things. One, we do live a lot longer, okay? And so you have, at age 65 even, and you're married and in average health, the second to die life expectancy today is about 30 years. So that's a long horizon you have to deal with. But more importantly, even than that, is it ignores two other factors that need to be considered in the equity allocation. And that is your ability to take risk, number one, and then your willingness to take risk. So by ability to take risk, I talk about one, of course, is your age. The longer you have before you expect to die, not retire, the more ability you have to wait out a bear market. And also, once you retire, you become subject to sequence risk because you're no longer getting cash flow from your earnings. You need to withdraw cash flow from your portfolio. If you get a bad return in the early years, you're withdrawing money, it can never recover because it's been spent. So you have to become more conservative, at least from that perspective, once you stop working. So that needs to be considered. The ability to take risk, though, what people miss is they don't consider their relationship or correlation between their labor capital and their equity portfolio. So, for example, a tenured professor at a major university or a doctor has almost no correlation of their equity risk and their earnings risk. Okay? So they can take more equity risk because they don't get laid off in 2008 or
yeah.
On the other hand, a construction worker or automobile worker is more likely to experience a negative impact to his income. So they can't wait out bear markets when they happen if it's an economic downturn, not just a stock downturn. They get laid off. They have to withdraw from their portfolio, so they should take less risk. And the last thing is what I would call the stomach acid test, or your willingness to take risk. You may be young in a very stable job, but if the market drops 40, 50%, which it has a tendency to do about once a decade or so, and you're going to panic and sell, or maybe even not panic and sell, but you can't sleep at night, you're worried about everything, you can't enjoy your life, then you need to lower your equity allocation and then develop a plan that still allows you to achieve your goals, possibly saving more or spending less, to allow you to achieve your goals. So we have three legs in the stool: ability, willingness, and need to take risks. And each of them should be firmly planted on the ground, just like the legs of a stool. If any one of them is out of balance, there's a good chance your portfolio will fail, maybe because of economic risk showing up, or maybe because of behavioral risk causing your stomach to take over the asset allocation decision. And I've yet to meet a stomach that makes good decisions.
Yeah, usually not, right? I think we'll just one more question, then we'll wrap up. You talk about too, indexed annuities in your book a little bit, and how that could not be great for some people. Do you mind just touching on that?
Yeah. Well, first of all, the concept of annuities is a really good one in principle because of what's called the mortality credits. You buy an annuity, you get the interest income from the investments the insurance company is taking, less their expenses and their profit. But you also earn the mortality credits because what happens is they're pricing it, let's say, at age 65 for people to live 20 years. Some will live 30, and they get the mortality credits from the people who died for whatever reasons, before the average. So you're getting those credits, okay? And that becomes a free lunch. The problem is, number one, the expenses have generally been very high, although today there are lower cost annuities without big commissions from firms like Vanguard. But the other problem is annuities, by definition, are going to be long maturity assets, right? Even at age 75, the average 75-year-old might have a life expectancy of 18 years. So now your big risk is inflation. And until recently, there's been no product that would provide an inflation hedge as an annuity with the mortality credits of more than, say, 3% a year. So that, to me, is a problem, and I wouldn't necessarily recommend those products. There is a new product from Stone Ridge, which isn't exactly annuity, but it's designed like an annuity. And it will, if you buy it at age 80 or just before age 80, it will pay out, including the mortality credits, up to age 100.
Okay.
And it can do that because all of the assets are in TIPS, or Treasury Inflation Protected Security. The product is called LifeX, and it definitely is worth looking at for somebody who's nearing age 80. At age 65 or 70, then you're incurring the expenses of the product, which is 1% a year. That may not be a bad idea, allowing you to lock that in, especially if you're locking in a high real rate on the TIPS. And today, that's, last I looked, a bit over 2%, so that's not bad. But if that TIPS yield was, say, 4%, as it was in the late 90s or early 2000s, then I might be very willing to pay the 1% to lock that in, because I think that's not like, I wouldn't expect that to persist. 2%, or somewhere in that range would be a more likely, because that's about the rate of growth of the U.S. economy. So
Yeah.
you should expect something like a 2% real rate. So I would avoid all annuities, my opinion, until about age 75, and avoid them if they don't provide an unlimited amount of inflation protection. For other people, though, it may be the case that they really, need those mortality credits to make their plan work. They might have to accept more inflation risk. That's something you have to decide for yourself, but it may give you those mortality. Say you're age 83. I think you have to annuitize before age 85. I'm not an expert on annuities, but that's my memory. And so at 83, now you don't have that much inflation risk, or you may live another 17 years, and you could, but the risk is less than if you bought it at age 65.
Yeah.
And now your mortality credits are very large at that age.
Sure. Yeah. Makes sense. Well, I think this is a great place to wrap up. Thank you very much, Larry. And, best of luck with your new book. I know it's been out since the beginning of the year. And again, if you want to check out more about Larry, I'll put a link in the show notes to his recent book and where you can find his other books as well. And this is episode 234.
Yeah, I would just recommend, since this show is for retirees, I co-authored a book with Kevin Grogan, and we recruited an all-star team of specialists to help us write your complete guide to successful and secure retirement. It covers 20 important issues, annuities being one of them, women's issues, how to pass on your values to your heirs and preparing your heirs to manage wealth, estate planning, as well as many topics on insurance and asset allocation, and including, importantly, how to live a good life in retirement and prepare for that as well. Because sadly, the highest suicide cohort in the United States by demography is recently retired males. That's because they don't have a plan to have a valued life in retirement.
Yeah. Well, thank you. And, as always, if anyone has a listener question for a future episode, you can head over to retirewithryan.com to leave your question. And thanks again, Larry. And, I hope everyone has a great start to your year and a great week. Thanks again, Larry.
Thanks for having me. Happy to come back anytime.
Okay. Thank you.